The year 2023 was a remarkable one for bond ETFs, with net new assets reaching an all-time high of $65 billion by mid-December. This surge in investor interest was driven by a combination of factors, including the normalization of monetary policy, the reemergence of inflationary pressures, and the search for diversification amidst heightened market volatility. Normalization of monetary policy. Following the historic low interest rate environment that characterized the 2020s, central banks across the globe embarked on a path of monetary policy normalization in 2023. This involved raising benchmark interest rates and reducing the pace of asset purchases, a move aimed at taming inflation and cooling down the overheated economy. The increasing interest rates environment presented a challenge for bond investors, as it eroded the value of existing holdings. However, it also created an opportunity for investors to seek income and stability in the bond market. Bond ETFs emerged as an attractive option for these investors, offering a diversified exposure to a broad range of bonds and the convenience of passive investing. Reemergence of inflationary pressures. Inflationary pressures, which had been subdued during the pandemic, re-emerged in 2023, driven by a surge in energy and commodity prices, supply chain disruptions, and strong consumer demand. This resurgence of inflation put renewed pressure on central banks to tighten monetary policy, further supporting the demand for bond ETFs as a source of inflation protection. Bonds, particularly those with longer maturities, can offer protection against inflation as their prices tend to rise when inflation increases. This is because the fixed coupon payments embedded in bonds become more valuable in real terms when the purchasing power of money decreases. Search for diversification. Amidst heightened market volatility, investors sought diversification strategies to mitigate risks and enhance portfolio stability. Bond ETFs, with their low correlation to equity markets, proved to be an effective diversification tool. Their exposure to fixed-income assets provided a buffer against equity market fluctuations, reducing overall portfolio risk. In addition, bond ETFs offered investors access to a wide range of bond sectors, including government bonds, corporate bonds, and municipal bonds, providing flexibility in tailoring portfolio exposure to specific risk profiles and investment objectives. Implications for the bond ETF market. The record-breaking year for bond ETFs suggests that they have cemented their position as a core asset class in the investment landscape. Their ability to provide income, stability, and diversification is likely to continue to attract investors, particularly in periods of market uncertainty. Going forward, the bond ETF market is expected to continue to grow, driven by factors such as the aging population, the search for income in a low-interest rate environment, and the increasing adoption of passive investing strategies. Conclusion. The record-breaking year for bond ETFs in 2023 highlights their growing importance in the investment landscape. As investors seek diversification, income, and protection against inflation, bond ETFs are poised to play an even greater role in managing risk and enhancing portfolio returns. Thanks for watching. I hope you found this video informative. Please subscribe to our channel for more investing tips and insights.